Okay. Hello, everyone, and welcome to another week of Learn It Live. Glad to be back. I'm Thomas Atkinson. I'm here with Tyrone.
Hello everyone, and yeah, welcome to the next Learn It Live session.
Got a good one tonight. So last time we covered some rules-based approaches, and tonight we're also going to use some rules-based approaches. Probably having rules with trading is one of the most important things you can do, especially as technical traders. We always want to keep that consistency in trading. So tonight we'll be talking about a rules-based approach to support and resistance. As is with every week, we need to just go over this disclaimer. So just read the first couple of lines and you guys can read ahead. So this information provided here has been produced by third parties and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. I'll let you guys just quickly read ahead there. And we'll go to the next screen. All right, so today we're going to be covering quite a few different topics. We're going to be taking a look at how to deal with false breakouts using market confirmation. We're going to look at how to identify some value reversal areas. So it's things like role reversals, but we're going to talk about why we call them value reversals. We're going to increase or find out how to increase our take profit percentages. We're going to be using some tools with that. So using Pepperstone's smarter trading tools, which some of you may be familiar with, and if you're not, you should definitely try to get familiar with those because they're great tools on MetaTrader 4. And then we're going to look at some live examples in the market right now. So I've actually got some examples we'll bring everything we learned tonight back into, and there's quite a few good setups that I think are happening in the market right now. Wouldn't you agree, Tyrone?
Yeah, absolutely. You know, the market's being really friendly to some of the setups that we're going to talk about tonight, so it will be a really good way to share what we've learned.
We'll also be doing some question time at the end, so if everyone sticks around to the end, you've got a couple of questions. We will try to answer a few of those, and we'd like to keep that going through the next couple of Learn It Live sessions, so people can really ask the questions that they want to know from actual traders that trade in the industry right now.
Yeah, just remember we are here to help, so even if you don't get your question through tonight, feel free to email it to us and we'll try and answer it for you at the next session.
Absolutely. We'd like to go through a lot of questions if possible. Okay, so first we want to start with how to identify or deal with false breakouts. And we want to use or let the market do it for us. So what that means is, I don't know if anyone here is probably familiar with things like channel trades or pattern trades or anything like that, but whenever you're looking at those kind of trades, and we'll use an example in a minute, you always want to make sure that you're looking at it on the clearest time frame. So multi-time frame analysis is something that a lot of people use or think about, and that's of course where you get like a 4-hour or daily chart and you check that pattern or you check that trade on multiple different time frames. And what you want to do is you want to look for the one that looks clearest to you and makes the most sense.
Yeah, the more important thing is when you are going through your multiple time frames, the clearer it does look on a particular time frame, you must remember that more people are seeing that, so there's a lot more chance that that pattern is going to work out the way you're hoping it will, because other people are trying to do the same thing. So it's always good to scan through a couple of different time frames and just see how clear it really does look. If you have to look too hard, it may not be there.
And moving on from that, that's where I guess something like $1 million test, or we call it the $1 million test, comes in. So I always like to think of it as if you had $1 million and you were trading with $1 million and we were trading 1% risk, which is $10,000, would you be placing that same trade? If the answer is no, and you don't think it looks clear or makes sense to you, and you don't think people are going to be placing those trades, then you probably shouldn't. Because at the end of the day, we usually want to be involved in the market at points where we're seeing value and other people get involved in that trade after we get involved in that trade. And we need the big traders to push the market in the direction we want it to go. So contrary to popular belief, we actually often do want the biggest traders with us. And we want to be recognizing those areas, and using the $1 million test has actually saved me quite a few times from placing bad trades.
Yeah, look, there's nothing wrong with following the herd as long as your reason for actually going in that direction is valid. So actually, the more people that are trading with you, a lot of people are scared of trading with the herd. And our theory is that if you're trading with the herd only because the herd is going in a direction, then that is definitely wrong. But if you've got a valid reason to do so, the more people that are actually going in your direction, the better it is for your outcome. So it's better to have the herd in your favor.
Yeah, and you've always heard the saying "trend is your friend," and that's always a good thing to consider, because trend's your friend because people are pushing it in that direction, and often those directional moves can last for a little bit more time. So when we find technical reasons to get involved with those trends, we definitely want to do so. The last one, probably the most important one, confirmation is always key. So we always want to make sure that the market is confirming what we're telling, we think it's telling us. So if we're looking at a channel, and let's say we've decided that that channel trade is best on a daily chart, then we're going to want to make sure that we get confirmation on the daily chart, as in the close usually of a daily candle above or below that channel.
Yeah, so by confirmation, we're basically meaning that if we do see a break of an area, the candle has to actually close at the break, not just seeing through and then coming back and closing underneath it.
So here we have a very typical kind of looking channel. We can see the resistance point up the top here with multiple touches, and we can see the support point down the bottom here. And we can see that it's broken to the upside. Now, to confirm this break, let's say this was a daily chart, we would want a daily candle to actually break and close above the previous highs. And that break would give us the buy or the buy confirmation. And it's very important we find these kind of confirmations, because otherwise you'll get those fake breakouts and you'll go back over and you'll get in early on like a 1 hour chart or 4 hour. I'm sure a lot of people have done that here before, and then you wake up in the morning the next day and you've lost all of your trade and you don't know what's happened. And there's nothing worse than making that mistake.
So confirmation doesn't mean that you go back to a time frame and see a break. So if you're seeing this pattern most clearly on a daily chart, you don't want to be going back to a 4 hour and waiting for a 4 hour close above that level and calling that confirmation. It must be on the daily close that you see that confirmation for it to be valid. Otherwise, you're really probably cheating yourself and leaving yourself exposed to a potential false break, which does happen quite often on these type of patterns.
And this goes for any trade. So it doesn't matter if you're using patterns or anything, but that you always want to make sure that the market is confirming, because when you've traded as long as we have in the market, you will find that by not following that confirmation, you will get a lot of false breakouts. It'll ruin your confidence. It'll ruin your system. And sometimes you'll actually have a system that's a profitable system and you'll give up on it. And there's nothing worse than giving up on a system that's
And it is actually quite a shame, because we do find that a lot of people don't believe in channels because of support and resistance false breakouts. But if you do trade them correctly and you trade them with the right risk, you will find them to be very profitable solutions to any trading plan. They are very good.
So here we've just got a channel, very, very basic. Great thing about pattern trading, one of the reasons we love pattern trading is because we can take the distance between the resistance and the support of this channel, so between those touches, and then we can say that that should be our take profit level. And we've placed the stop loss in the most safe area here, but we're going to talk tonight about value stop loss areas and how we can maybe enhance our profits. So we'll talk about some different places we could potentially place our stop loss in these kind of trades, because we are actually seeing quite a few channel breaks that have happened in the market. Specifically, if you open your charts, you'll see it on the odd US dollar, and you'll also see it on the pound yen. So we'll take a look at those in a minute. So let's actually jump straight into the charts and take a look at the odd US dollar to get started. So here we have it, odd US dollar. Probably a lot of people here's favorite. We're in the time frame for Asia, so it's good. Now, with this particular trade, whenever we're looking at it, what I like to do, and we're on a weekly chart, by the way, is I like to bring it back to the line chart and just look at it from a simple support resistance base. So if we consider this just our support resistance, what you'll notice is there's a clear support line here, and there's very clear resistance that's formed over multiple touches over time over here. And we can see a break over here somewhere in June this year. So if we take a look at that and then go back to the weekly time frame, what we'll notice is that on the weekly, this looks very clear. If we go to a daily and zoom it out, it's not going to look as clear to us because it's formed over a long period of time. So we're going to have to zoom it out multiple times to be able to see this. And therefore, the big traders are usually going to look for the one that looks most clear, and they're going to go to that weekly and say this is a very clear pattern. This is a clear channel. We've got multiple touches to the top side, multiple touches to the bottom side, and then we can see this massive break candle that's happened here. And the importance of this break candle is if we go to a bar chart, we're not going to see it as clearly. But when we go to a candle, does everyone see that this is a close above all previous closes? very clearly a close above all previous closes. So we can ignore this wick, because what a wick is it's saying that the market wasn't able to make that high, or at least hold that high for that week.
Yeah, all it is basically price has gone through that level, yes, but it has failed to close up above it, which is the important part, because most of the time the close is the important part of any candle or bar. So if price didn't hold its momentum or strength above that zone and did pull back in, it's often a sign that it's going to reverse even a little bit. So closing outside that zone is very important.
The close is really everything to this kind of trade. So that confirmation is what we're looking for here. And then, of course, we can choose whether there's enough reasons for us to get involved in the trade long here. You can see that upward momentum was very quick, 2 large weeks of trading up, which may have been enough for our profit. We also, of course, can see that it went to try a new high. And now we're seeing an interesting point, and this is what we call a role reversal point, where the market's coming back and testing these previous resistance points, and this resistance is now acting as support. And we'll go through role reversal in a minute, but I want to jump into the pound yen because it's showing us something very, very similar. So we jump over to the pound yen chart here, and what we'll notice on the daily chart, again, we go to a line chart, just have a quick look. It kind of cleans it and cuts it out, and that's because it's based on the close prices. And we can grab our support, and we can grab our resistance, and what you'll notice is there's 2 touches to each side. And then the market has broken through over here, and now it's come back down, it's retesting this zone. So if we go back over to a candle, again in this one, what happened was the confirmation candle was here and actually closed above. And it may look a little bit disheartening, but what you'll often notice is that if you see something like this and it's confirmed and it's gone 300 pips and we've missed out on that 300 pips, which obviously sucks because we're waiting for it, what we want to do is we often see the market come back and give us a second entry. So if you lose an opportunity, I think patience is another key virtue, I guess, of a technical trader or any trader.
Yeah, absolutely it is. And when you look at it from a conservative standpoint, actually waiting for the retest of that zone is definitely a more conservative entry, really. So what you are confirming is that the zone is well and truly broken. And when it does come back and retest it, the reason we call it a value role reversal is because it's giving us multiple reasons to actually retake this trade if we missed out on the initial blast. So when we look at it now, we can apply some different technical analysis tools to actually confirm that this could potentially be a very good level to buy.
Yes, this is going to be way more value zone than just watching the break by itself. We can use more technical analysis tools, as Tyrone said. We'll take another look at this chart after we talk about role reversal, but one thing I did want to say was it's very important that we don't just get involved in markets like this, and that's because our take profit levels for, let's say, this channel trade would always be this distance. So it should be around the distance of the length of the channel, which is here. Now, if we were taking that here and our profit was only going to be about 500 pips, our stop loss would have to be most likely below the last swing here or here. So risk reward wise, it may just not make sense. And that's something that we don't want. We always want things to make sense for us, because if we risk $100, we'd like to return at least $100. We don't want to return $90 or $80 because that's going to ruin our statistics.
Absolutely. And the thing is, it's probably very important to make sure that you never actually risk any more than you plan to make. So 1-to-1 should be the absolute minimum that you should ever aim for. If you're risking $100, you should never be taking under.
I guess I'd also like to point out that a lot of people, we all know, we trade the 15-minute, we trade the 1 hour, we trade the 4-hour charts. We will be using a lot of daily, weekly, 4-hour tonight, and we'll probably use that through the next coming weeks. And the reason why is because it's a little bit more consistent and it's often there for us to talk about. So these methods we talk about will work on the smaller time frames. It's just that being on the bigger time frame, more people see it, and therefore the bigger traders will also see it, and they usually work out just a little bit higher percentage of the time.
Yeah. As some of you are probably aware, we also do the technical analysis wrap on the webinar series, and you'll see it in the technical analysis Tuesday and Thursdays. We often look at a lot of the smaller time frames in those times. So if there is ever a good opportunity on a small time frame, we will bring it up that night anyway. So don't be afraid, we will be looking for the smaller time frames if it's there. So we will definitely bring it up.
So let's go back into some of the theory and talk about how to identify role reversals or reversal zones. So we're going to talk about what is role reversal. We're going to talk about why we call it value reversals. So the reason why that is because we're going to find multiple reasons for using that role reversal zone and to be in that trade. We're not going to just say, this is a role reversal zone, let's get involved in it. We're going to say there's other reasons for us to be involved in that as well. One of those other reasons is going to be Fibonacci retracements, and role reversals often in their essence is support resistance. So we like to see maybe more support or resistance, which could mean more touches. Let's take a look at role reversal, I guess, as a technical. So here it is as an example with 2 touches. It can also be 1. So we can see here that the market is going up in a bull market. It's hit a resistance point. It's come back. It's hit the same resistance point. And then at some point it's broken through. And then when it does break through, just like normal in the market, it often comes down for a second retest. And this is where we often want to be as value traders, looking for a better risk reward payoff for our trades. So we can then pick it up where the resistance acts as support. And this happens obviously in bull or bear markets the same way. So it's just the opposite direction of this. Here's a bit of an example, I guess, in the real markets. So we can see here multiple resistance points over here, and then the market's broken through, big, large confirmation candle. We may not have got involved there because maybe the candle was too big, and then we can see that pull back into the previous resistances here, which acts as support, and eventually that support holds, and the market continues to move on. And this is just a 4-hour example on the euro.
So the problem with a lot of breakouts when they first break out of a resistance zone is quite often it is a very large candle, as you can see here, and it does happen quite often. Unfortunately for a lot of traders, it means that you may not be able to actually get on it at the time that especially if you're waiting for confirmation. Like Thomas said, your risk reward is going to be way out of whack if you're only getting this on the close. And I think part of the reason why a lot of the time the market does come back is it's almost like the initial buyers who have basically taken that trade are taking profits at the first zone, and then it comes back and traces back a little bit slowly, as you can see even in this example. But then it does create a very good buying opportunity for all of the people that have missed out. Because believe it or not, support and resistance is a very, very popular trading method around the world, and role reversal is no different. In fact, role reversal is actually treated as a stronger zone than the initial break, purely because there are far more reasons to actually buy it at this level, because it's more conservative to begin with, but also the area has proven to be resistance, which actually is almost doubling the support that would have been there otherwise.
Yeah, Tyron's actually got a bit of a unique perspective on this. He's actually done the CMT in the US, which is also a course that's done by a lot of hedge fund managers. So they use these kind of points. It's probably one of the fundamental trades, I mean, really in terms of swing trades and getting involved in the market, wouldn't you say, Tyron?
It is, yeah, because they do everything at a conservative level, so that's why it's considered a very conservative entry when you do it. But like Thomas said earlier, it also means that your risk reward is going to be far better because your stop loss needs to be a fair bit closer than it would have been on the initial break of the channel.
I think another thing, though, a lot of people don't really get about the Forex markets is often they're a massive market. Obviously, there's millions, if not billions of dollars being traded all the time. So when you're getting involved in this market, think about this just from the logical standpoint. If a hedge fund manager or bigger bank or trader gets involved, they're not going to just enter one position. They're going to enter a position potentially here, and then they're going to maybe add to their position if the market goes above these resistance points here. So they're going to add here, and that's why there's often those strong break candles, and they're going to continue to add to this trade until they hit take profit. So they're going to scale into the trade as well as they'll scale out of the trade, because they're using such huge money that they may not be able to just click the button like we can and just close the order. And that's actually an advantage to us as traders, but it also helps for us to think about the psychology of what other traders are doing. And I think a lot of people don't think about that.
Yeah, a lot of people are afraid that people are going to catch on to their trades and they're going to be trading the same way they are, so liquidity is going to dry up. That's just not going to happen in the Forex market.
Yeah, you have to do very, very well.
You have to be doing very well. And if liquidity becomes a problem for you, then you probably don't really need this webinar. So yeah, just on that standpoint, don't be afraid that everybody else is seeing the same trade, because it's going to work in your favor if they do.
Absolutely, yeah, especially if they're the big traders. So let's just go back now and think about that role reversal before we take a look at Fibonacci and look at that odd US dollar and pound yen example. So I just want to talk about it. So you can see here the previous resistances, so pound yen daily this is, if anyone wants to have a look and open their charts. You can see the previous resistance here and previous resistance here, and the market has broken through very strongly, has come back down to this level, and now is finding some form of obviously support here in the previous resistance zones. The thing that makes this stronger is there's more than one touch. We can see here big resistance touch over here, quite a few little touches over here, and then of course that's going to be more visible and therefore clearer to a lot of the big traders. And as we said, clearness is very, very key, and also confirmation. So we're going to look for confirmation here that this is acting as a support level. You can see this nice green bullish candle here. That may be just enough for us, potentially. We might look for other reasons. We'll talk about Fibonacci in a minute. And then we could get involved in a trade here with either the idea of maybe taking profit up at the previous resistances or taking the profit at the total distance of the original channel break, which should be around here.
The great thing about role reversal is that unlike a normal support zone where you would be waiting for at least 2 touches to confirm support, a role resistance area can be traded basically the first time it touches it, because the resistance previous is acting as your support base. So in a normal situation, if we didn't have a role reversal and we were just going to trade an area for support only, we would generally have to wait for this market to bounce off this level and then come back and retest it to actually act as support. But we're getting the added benefit that the resistance has already created this basically floor in the market, that we can trade this first zone. So as soon as it comes back, which is where it is now, all we're looking for is probably a short-term trend reversal in price, and we're off and running.
And what you'll notice is often these points are around double zeros. So we can see here that somewhere in this zone is around that 148 area. Often double zeros in currency don't mean as much, but we do like round numbers. So just like we like $100 bills, people would like $100 more than they'd like $98. Same kind of thing happens in the market, and that's not just because you have $2 more.
I like the $1,000 euro bills myself, but
yeah. Well, that's even more, so that's good. But round numbers mean a lot of things. So if you ever see currencies, and I guess here's a great example. We'll just use the US dollar yen quickly. We'll jump on that chart, and we'll go to a weekly. What you'll notice about this weekly, actually we'll just jump on the monthly for the US dollar yen, is if we go down to parity, which is basically 100 with the US, so where they're both equal, look at the amount of times that the market has come and found support, resistance, support at this level. Very, very key. And when you see these things in the market, you should get excited because it gives you a good opportunity.
And this actually shows a really good example of how what was resistance at the first break has become a really good support zone at that level. So this was a really key area for it, because not only was it a parity level, but it did break through initially quite heavily. And this is a monthly chart, remember, so we're talking nearly 6 or 7 months of trading here in this zone. But when it did eventually blast through, we can all see what happened. And as soon as it's come back down and tested this level again, it's given it the same respect that it did again for nearly a 6-month period. But again, it's blasted off into the stratosphere.
And I know everybody says, of course, past predictors don't predict future. But again, this is a monthly chart. This is nothing to sneeze at. This data here in Pepperstone goes back all the way to 1996. So this level is a psychological level. It's humans. We're trading this market. Therefore, we do respect it. And you can just see the amount of respect that it's gotten. Notice the market doesn't like hanging around these zones very long. It hits it and finds another zone pretty quickly. So it's a good thing to think about.
One thing we also need to be mindful of is that role reversal works the other way as well. So when an area of support has been drawn, as we can see here, parity has been support 2 or 3 times. When it did eventually break through, as we can see, price came back up and literally touched it to within half a dozen pips and sold completely off it again. So that's just another example of role reversal, only in reverse.
Yeah.
So support basically becomes resistance once it does break through, even at key levels on the way down.
And remember, it works on all time frames. So if we're using, if your chart of choice is 15 minutes because you like to trade the London session like we're in at the moment, then maybe you want to get on a 15-minute, 1-hour chart and look for those heavy support zones that are being broken and potential retests of those zones. Because just that by itself is surprisingly a very good technique, especially when you bring it over with Fibonacci, which we'll literally look at in probably about 30 seconds.
Yeah. I've met many successful traders who purely trade support, resistance, and roll reversal zones only, and they're very, very successful at what they do. Yeah, hence how powerful it actually is.
And they teach this very heavily in those CMT courses as well, and those kind of things in the US for hedge fund traders. So go back to the Australian US dollar here. What we'll see is we can see here that we've got this strong resistance. Again, the stronger the previous resistance when it breaks should be the stronger support in the roll reversal. So here, many, many touches. You can see the markets come down. We had this order in with the required risk management from, actually, I think we put this in about a month and a half, no, more, 2 months ago. And funnily enough, it's hit it. We just left it here, and we got grabbed last week. So almost perfect to the pip, but that's because we know that this should be a zone where the market finds some form of support.
For those of you who don't know, this account that we're trading here is actually a Pepperstone live account that we're going to be placing our trades. Any trade that we see that's actually live in the markets when we're doing these webinars, we're going to place with the correct risk management. So you can actually see them play out from week to week or fortnight to fortnight. So just keep an eye on some of the trades that we're placing here, and you'll see how we basically manage risk and go for our take profit and stop losses.
So this is quite a good one here that we're obviously looking at, and we probably want even more reasons, but we thought we'd open this one for tonight just so that we could do some testing for take profit with the systems later. All right, let's get back in and talk about Fibonacci. So we'll go back into the slides quickly, and we'll pull out Fibonacci retracements. Ty, would you like to just take over quickly here?
Yeah, Fibonacci retracements are a very popular trading method, but what we've always found is that in isolation, they're just not as successful as people would have you believe. But what they do is give you a lot of confirmation when you can see something else in the market that they're confirming. So it's not that they don't work, it's just they don't seem to work in isolation. But when you overlay them with, say, a break of a support zone in a channel, it will make a very, very big difference to what people are seeing, because there are a lot of Fibonacci traders out there who just purely trade the 38, 2, and 50 levels. So if any level that you're wanting to enter coincides with a Fibonacci retracement in the right area, it's going to give your trade a lot more power.
Yeah, so you can see here some of the main ones. Obviously, you've got the 23.6, 38.2, 50, 61.8. They're all very good ones. We actually prefer probably the 38.2 and the 50, and that just comes from a long experience of trading. And that's because we don't really want the trade coming back too far on us. I think we'll cover Fib a little bit more detail in the next couple of weeks, but for now, just say that the 38.2 and the 50 are definitely two of our favorites.
Yeah, and for those avid Fibonacci supporters, yes, we know that the 61.8 is the golden ratio, but in our opinion, if it pulls back to the 61.8, sometimes it's come back just a little bit too far. So we would prefer that it only pulls back a 38.2 or a 50, because that's just a nice level where the trend doesn't lose too much momentum and it can actually continue on in the direction without having to break too much more resistance.
We want a trend that knows what it's doing.
Yes.
We don't want to be on the trend that doesn't know what it's doing.
No one wants the trend that doesn't know what it's doing.
Just quickly, obviously you'll be able to get these videos later after this session, so you can have a look here, but this is how you want to draw Fibonacci. So you want to click it from the low and draw it to the high if you're looking for Fibonacci retracements in an upward movement, and the opposite for downward movements. So let's now just go back into the charts quickly and draw some Fibonacci's just off these previous moves. So first I'll go back and we'll go to that pound yen, and we'll go to the daily, which is where we found it. And I think here, look, there's two ways of thoughts here. I mean, we could draw it from this swing. We'll draw it from the whole swing though, because I think a lot of people are going to look there. We'll grab the Fibonacci tool, drag it up here, and what we'll notice is there's a lot of confirmation here, funnily enough, from the Fibonacci that's saying, well, look, here's a 38.2 retracement that hits our previous high. So we've got those resistance points over here. The resistance has been broken and it's come back down, funnily enough, to one of our favorites, the 38.2. and now we're seeing some bullish momentum coming off this.
The 38.2, like given this level, is really, really strong. And if for those of you who are in doubt as to whether you should go from the highs of the candle or the close of the candle when drawing your Fibonacci, we always err on the side of going from the high to the low. So trying to cover as much as you can. And like Thomas said, when you're in a little bit of doubt as to where to measure the swing, it's always better to go for the bigger swing because that's the one that the majority of people are going to trade. Because there's no point drawing a Fibonacci that no one else is seeing. So we want to try and make it the most popular and most efficient way to do it. But as you can see, this one here, it pulls back right to the 38.2, which is the optimal zone, right at a level where we would expect this market to find very solid support. So this is what we would definitely classify as a value roll reversal.
Yes, we've got the Fibonacci overlay, we've got that really strong resistance, more than one touch. We've got 3 here, 3 previous massive resistance touches. That's extra value to it. And then, of course, we can use things like candle confirmations. We can use other methods, moving averages, all sorts of things to give us extra confirmation of this roll reversal. So for tonight, we'll just talk about the Fibonacci and we'll talk about the support resistance. But you can see that you can build some of your ideas around these systems. And that's what we want to get into. We want to talk about different systems because there are lots that work. This is just one that you can build upon to make work for you.
And just so I can just explain a little bit further about what I was talking about with the 61.8, if we have a look at this drawing, if the price had have come back all the way to the 61.8 level, which is down here, you'd see that it would have actually had to have broken this support zone to actually get there. So if price actually did get to the 61.8, not only has it lost a fair bit of momentum and broken support, but for it to actually go forward now, it's going to have to actually break this support again, or the resistance again. So what it's going to have to do, it's going to have to go through another resistance zone after it's broken support just to get to the same level as where we should have entered it in the first place. And that's why we think sometimes if it comes back too far, it's better off just to be left alone, and we'll leave the golden ratio alone.
Yeah, we'll get rid of the golden ratio for now. We'll go back to the odd just quickly. We'll grab the Fibonacci tool. We'll just take the whole move in this case. I know it's black, so we'll just use our template tool. Run it live. We will grab, zoom in a little bit here, and we'll just grab this move here. And what we'll notice that in this case, again, one of our favorites, 50%, that's always nice. The market has come down and the 50% of this fib has ended up being the resistance point, which should now be a roll reversal point. And again, this is the confirmation that you like to see from the market. The market should be confirming multiple systems and multiple rules. And if it is, then it's kind of like a beautiful thing. It's like putting all of the I guess the clues together and getting that I guess, you know, eureka moment where you go, okay, cool, this is a great trade, I should be in this, and you can be more consistent with your trades.
Like we said earlier, the more people that are trading in the direction that you want to go, the better the chances your trade is going to have of success. So if you've got Fibonacci traders taking the long position here, you've got the roll reversal traders, potentially candle traders, or even short-term reversal trend traders all going in the same direction. It bodes very well for a reversal here, which is obviously what you want to do when you're going along at this point.
So now let's look and talk about how to increase our take profit percentages. So obviously we talked about the support resistance zones there, but what we want to do is we want to spot the most likely point of the next support resistance. So there's the conventional way of looking at a system and saying, okay, that's where we should place the stop, that's the more conservative stop. But sometimes there's going to be other places when we become more experienced traders where we can say this is also a point where we can potentially place our stop loss and therefore improve our take profit percentages. Now, importantly on this, we need to be, I guess, honest or true to ourselves. Sometimes we'll just go, let's put a 50 pip stop loss on it, but that's not being market adaptive. That might let us trade a bigger trade at a bigger contract size, but that's not always the best thing. We need to let the market tell us where the stop loss should be. So whether that's behind a moving average, whether that's behind something else, we can often use that. I think we've got a question here, actually, we might just go over. How do you decide which time frame to use, daily/weekly? So in this case, if we go back to that example, I guess I'll just do it quickly. What I usually do is, again, wherever I've seen the pattern, so wherever the pattern looks the strongest, I'll still stick to that time frame for drawing my Fibonacci. So in the case of the odd US dollar, the pattern looked the best on the weekly for us. So it didn't look as good on the daily. It looked better on the weekly. And therefore, we will probably use the Fibonacci based on the weekly, because even then we should be looking for the role reversal based on the weekly as well. In the case of the pound yen, the pattern was best on the daily, so therefore we're going to use the daily for the Fibonacci.
What you will find also just on that is that if you go down to the smaller time frames, quite often you might get a Fibonacci overlay where you might draw another swing that's going to be a little bit smaller on a smaller time frame, and it may actually get a double confirmation of Fibonacci. So you might have, you know, two key zones on different time frames that will actually confirm what you're actually saying.
Yeah, we'll talk about Fibonacci overlay probably in another session, but it again, further confirmation, best thing we can see. So we want to spot the most likely point of the next support resistance. We want to potentially have multiple take profit points for our orders. And we'll be talking about, and we'll actually use the tool in a minute that Pepperstone's got that allows you to actually do that using trend lines, which is quite cool. So that will allow us to potentially close part of our order, close a percentage of our order, instead of just having the full order on all the way to the end. We could say, okay, this could be our first point of resistance, this could be our first danger zone, and we can scale out of those orders, kind of like the professionals do it. Like that's what they do, they scale in and out of orders. So it's definitely something we can use. And of course, the most important, always follow your system. So if your system has, you know, number one key thing, you're using support resistance and maybe patterns, then you should always be looking to at least have some form of support resistance and definitely a pattern in that trade. If you don't have those two, or maybe even trend as well, if you don't have those, then you shouldn't be trading. And that comes back down to that $1 million test. Would you put $10,000 risk on that trade? Because if you honestly can tell yourself you wouldn't, if you had $1 million in your account, then you shouldn't be putting $100 on that. You shouldn't be putting $5 on that, because it doesn't matter how much money it is. At the end of the day, you want to scale trading just like a business. And to be able to do that, you need to keep your psychology the exact same way as you go up those levels. So if you start with a $1,000 account and you're turning that into a few $1,000s, then you've done a great job if you're doing the right risk management. Then if you get that few $1,000 or $5,000 or top it up or whatever you want to do, and then you make more money with that, then you can scale up, and your effect will be a consistent profit, just like a business should have a consistent profit.
Yeah, trading is definitely a system, and it's definitely a business, and it needs to be treated that way right through. So keep your gut feelings at the door when you're placing your trades. Just always follow your systems, and the rest will take care of itself.
So let's take a look at placing a trade. Well, we've already done the placing a trade, but what we want to use is we want to use the Pepperstone Smart Trading Tools to potentially scale out of that trade. So let's take a look at this odd US dollar again. And if you install the MetaTrader 4 Pepperstone Smarter Trading Tools, you'll notice there's a thing called the mini terminal. So we can drag and drop that using the left mouse button. We can pop it on the charts, and then it'll bring up this little window. Now actually in this window, what we can do is we can click the little yellow button, and you can see here all these sorts of lot size calculators, so we can figure out how much we want to place in a risk. You've got percentage of equity, percentage of balance, really cool stuff. You can save that as a template. But what we want to do here is we've already got a trade open. So we actually grab the Trendline tool here, we can drag it over the chart, and then we can left click and click Alt. So use Alt and left click when we click on that line, and you'll notice it brings up a thing called Smart Lines. And here we can actually select our ticket. So in this case, this is our trade that we've got open. We can put a take profit, and then we can put a scaling amount. So let's say if the trade came up here, we can actually change how much of our trade we'd like to close at this point. So if you're doing, let's say, a trend line type of trading system or moving averages or something like that, you can adjust these trend lines to potentially scale in and out of your orders. So it's a really, really cool tool. So if we put 60% here and then press save, you'll notice that line has now changed to yellow, and it has here a take profit close 60% of our 0.05 of a contract. So if that was one contract, obviously it'd be closing 60% of one contract, or 0.6.
It's a really, really handy tool, and if you haven't got this on your system, definitely talk to your account manager at Pepperstone, because they're a very, very handy toolbox, including the mini trade terminal. You really can't go wrong with your lot sizes and your stop losses when you use that tool. So I really encourage people to use it because it's very, very handy.
And it's much better than going to a website randomly somewhere and trying to do currency conversions. So.
No, I've noticed a lot of people do that and they just never get it right. This mini terminal works perfectly every time. So it's free to Pepperstone clients. So yeah, talk to your advisors and get it on.
Yeah, I definitely would suggest that. So I guess we'll put it over to Q&A. We'll see if anyone's asked any other questions. Fabian, do we have any questions to end up tonight?
There's a few. The first one actually in regards to the Smart Trader tools. It's free for funded Pepperstone clients. So yeah, definitely speak to the account manager or support to gain access to that. Okay. The first question would be, when trading these technical levels, and you notice that there's a big fundamental event coming, which one would take priority, like a fundamental event or a strong technical event?
Okay, so when you're actually trading these bigger time frames, look, I think on an hour, it depends on your time frames. If you're trading an hour or a 15-minute chart, obviously a huge fundamental event is going to have a super effect on your trade. So if you, let's say, even looking at CPI data or interest rate decision or something, it can definitely move the currency, hundreds of pips, but often it'll move it like 30, 40 pips. And that might blow out your stop losses. It may not blow out your 150 pips stop loss on a daily chart. So the thing about that is that we want to really figure out what that news is and whether it's going to move the market. And I would generally actually stick with my trades with trend. And the only difference to that would be things like US elections, non-farm payrolls, which is obviously once a month in the US, and massive interest rate decisions or elections around the world. Because other than that, your technicals should work, and the actual fundamental news should be helping your trade more than it should be detrimental towards it.
Especially if you're going in the direction of the trend.
Yeah, once you've ascertained that trend, and you can do that, of course, with moving averages or just viewing the charts. I'm sure if you take it out to a bigger picture, a lot of people can see at least the general trend. Then if you're trading in that trend direction, which you will be with role reversal, I think you'd be fine.
Awesome, thanks guys. Another question would be, when you're drawing the fibs, do you draw it to the tops of the wicks of the trend or just to the close levels?
We do it to the wicks. We just choose to take the whole trade, and that's because it's the clearest to everybody. There's no real questions about that. Some people do switch it to the line charts, and then they take it from the actual closes, like here. Oftentimes, you'll find if you actually draw it and you want to prove it, sometimes the fib levels you can see here. The fib levels are a little bit off, but they're still in that same range. So I like to do it from the wicks, and that's just because I think that's the clearest and it's the most respected through most of the, I guess, the industry.
Yep. So the highest high to the lowest low of that swing.
I noticed someone here just said, how do you open the mini terminal? So of course, once you've installed the mini terminal, which is actually just a click of a button, I think, you can just left click on it and just drag it onto the chart. And it's just like left clicking on a currency and dragging it onto the chart. Very, very simple.
Thanks, guys. Another question would be, what would be more ideal trading strategy? Would it be like swing trading or day trading or sort of a mixture of both?
I think it depends how much time you want to put in front of the charts. If you're the kind of guy that wants to sit there for 3 to 4 hours a night, then you can definitely swing trade the smaller time frames, so the 15-minute, 1 hour, but you're going to have to be obviously involved in those charts. If you work during the day, then swing trading is absolutely fine as well, but you're going to want to use more like a daily 4-hour weekly chart. And that's just so that you don't have to check it as much. You can have bigger stop losses. You're not going to be kicked out by small bits of news, that kind of thing. Tyrone?
Yeah, it's basically, I mean, when it comes to the time frames, you pick the one that you think is going to suit your lifestyle the best. But what's important, the methods work in any time frame really. It's just the most important thing is to make sure that you keep your expectations correlated to the time frame that you're on. So if you're trading, for instance, a break on a 1 hour chart, you can't be realistically expecting a 5 or 6 cent move from that. Whereas on a weekly chart, it could easily move 6 or 7 cents just purely because of that's what the pattern is saying. So you have to keep your expectations in check and keep them relevant to the time frame that you're on, and then all of these patterns will work on every time frame.
I think one thing we're definitely going to cover as well, I'd like to cover it when we've got a little bit more time, I'd like to cover, in essence, when we are swing trading, where we should be potentially placing these stops. So you'll see here on this chart, actually what I did was I went down to a smaller time frame and I looked for the last major swing. And we can do that just with the line chart. You'll notice there's a big swing here, then the move up, and then of course it's come down to this point. So just under here is a very good, not so conservative stop loss. Obviously conservative would be down the bottom here, but because that's a last very clean swing in the market, a lot of people are going to see that, and that should act as heavy support. The other thing I've done is I've drawn my Fibonacci from the whole move, and you'll notice this stop is also after the last Fibonacci. So if the golden number is going to hold, we've given it the room for it to hold, as well as what the market's telling us. And hopefully that makes sense to a lot of the guys out there. You can put practice in. Practice makes perfect.
It does. But we will explain that further in a session that will dedicate mainly to stop loss zones. So
I think, yeah, stop losses, it's easy to click the button into the market, but it's very difficult to not only, I think even take profits are easier, but stop losses are very difficult because we all have a tendency, and I know we did originally when we started trading, of just saying we'll give it 50 pips or 100 pips or 20 pips, and having that static fixed, we would not change our stop loss for anything because we wanted to trade the same contract size. It is the #1 mistake everyone makes.
Yeah, you'll soon learn that stop losses have to be where stop losses have to be,
yeah,
and the contract sizes get converted to suit the stop loss.
And that's why something like the mini terminal is really good.
You just can't go wrong with the mini terminal.
Yeah, I've got one more just before we finish up.
Yeah, just in return back to the Fib tool, do you ever use the Fib extension as well as the retracement?
We do definitely use the Fib extensions. Fib extensions are good when you're recognizing maybe a longer term trend where it has multiple moves. So if you were seeing something like maybe a big sell-off market like this, maybe the little pullbacks that were happening in this, we might be using Fib extensions to figure out the next point. So Fib extensions are their own kind of trade. They definitely deserve attention, but I think we'll have to probably cover that another time. You just can't explain it in only a few minutes.
We do find, though, with the Fib extensions that we often find that there's better take profit zones and levels using the market itself rather than actually the Fib extensions themselves.
Yeah, you'll use those more, just like we're using Fib here, more of a extra kind of thing for our trade.
We'll focus on some sessions down the track.
Yeah.
So guys, that is us for the night. Thank you for joining us. Now we'll be back in a fortnight's time around the same time at Tuesday fortnight. So if you have any questions in the meantime, feel free to send them through. And don't forget to check out the FX Lounge. We've got the technical analysis update every Tuesday and Thursday for the major pairs. And yeah, we look forward to seeing you next time.
Absolutely. Good trading, guys.
Thank you, guys. And just to remember,